Good morning, everybody, and welcome back to Morning Markets. A couple of things that we've been discussing this morning that I wanted to share with you. The first of which was the continued testimony of Jerome Powell yesterday at the Senate Banking Committee in the US. Why was this interesting? I think he's continued to focus on unemployment and the need for unemployment to improve to support economic improvement. And interestingly, within the discussions yesterday, he did focus on the need for continued fiscal support through pushing back to the government and to the politicians in the US, the need for them to continue to step up to the plate. And that's important because we have a number of the support packages that were enacted in the US on a temporary basis, particularly those related to providing support to those losing their job as a result of COVID-19 that expire in July. So really throwing down the gauntlet and saying you need to continue with these programs and they need to be renewed. I think that's added interest at this point in time, just given the electoral calendar in the US, where we're starting to get closer into the presidential election process. And this requires both the Democrats and the Republicans to work together to renew these packages and also to think about other packages that may be required to support the US economy at this point in time. So that clearly is an interesting situation for us all to observe over the coming weeks as we come to the expiry of some of these temporary support measures. The other thing then, just looking at asset markets yesterday, a relatively subdued performance from equity markets across the piece, with Euro Stoxx 50, the FTSE up. In the US, we had the Nasdaq up marginally, and then we had the S&P down about 40 basis points. So no real movements around in equity markets, and a very similar picture was observed in bond markets and also in currency markets. So not a lot of movement to really discuss there over the past 24 hours. I do think, however, that one of the factors that we touched on yesterday is increasingly prevalent, and that is just the concern and the news flow that is around the number of areas where we are seeing pick up in COVID-19 infection rates, primarily in a number of US states, and then the situation that we've seen as well in Beijing. And that's weighing on sentiment. It's one of those things that we've been discussing over the past number of weeks and indeed months about how market sentiment will wax and wane based on what happens with COVID-19. I think the other thing that we did see is just that from China, a little bit of incremental discussion around the support packages that may come through there. So expectations that some further monetary support measures will come into place in China in the coming weeks, just to support the economy through this period, and I suppose to address the issues that we're seeing, particularly in Beijing at this point in time, where there will have to be closures, and there are ongoing closures, and that does impact economic activity and economic recovery. I think the other thing that we touched on this morning was around OPEC. OPEC provided some detail around how they're seeing the demand environment in the second half of the year relative to the first, and we know the challenges that the oil market has faced over the past number of months, where we've seen a very dramatic shift and curtailment in demand, with some estimates suggesting that demand from OPEC itself, they're suggesting that demand was curtailed by about 11 to 12 million barrels per day through the first half of the year. And that's obviously an average, and it speaks to the very significant declines that we saw at the height of lockdowns across the global economy. They're projecting that demand will still be weaker in the second half, but albeit not as bad as in the first. So they're estimating that on a daily basis, oil demand will fall some 6 to 7 million barrels per day relative to their starting forecast. So again, recovery, but not recovery to the extent that it takes it back to previous demand levels. Then just turning to thinking about the next day and what we're likely to see today. Well, we've got the Bank of England meeting ongoing at this point in time. There's no expectation that any change will come at interest rates, with interest rates being at the low level of 0.1%. What there is in growing discussion around, and we did see two of the MPC members voting for this previously, was an increase in the quantitative easing programme. So there's an expectation of some 100 billion incremental quantitative easing to come, or potentially more from the Bank of England today. So that should come out around lunchtime. And the situation for the bank, I suppose, is aided by the weakness in the economy, and also the fact that the inflation print yesterday was at 0.5%. The target that the Bank of England has is 2%, so a lot of leeway there. We also will have continuing claims and initial claims in the US, and it'll be important for us to see how that trend evolves. We cast our minds back over the past couple of weeks. What we've seen there is a declining trend in new claims and also in continuing claims. So it'll be important to see if that trend is sustained, which will then give us an indication as to how the US economy is recovering, and in particular how employment and trends in the US are recovering. That's it for now. Please join me again tomorrow. Many thanks.